One important factor for individuals and businesses seeking to take out loans is the interest rate offered by the lender. In Africa, interest rates can vary greatly between countries, with some countries offering relatively lower rates than others. For those seeking to obtain financing or invest in the continent, exploring the countries with the lowest interest rates can be a valuable starting point. According to recent reports, there are 10 African countries that currently offer some of the lowest interest rates on the continent. These countries could potentially be attractive options for borrowers seeking to obtain loans or for investors seeking to invest in emerging markets. Sadly, the majority of African countries have outrageous and unsustainable policy interest rates when compared to their inflation rate and general economic performance. In this video, we shall be looking at the list of the 10 African countries with the lowest interest rates. So, without wasting much of your time, let's dive right in. 10. Burkina Faso. Burkina Faso is a member of the West African Economic and Monetary Community. The Monetary Policy Committee of the Central Bank of West African States makes interest rate decisions in the West African Economic and Monetary Community. The economy in this country remains unstable due to the country's limited export base, which consists primarily of zinc, cotton, copper, and gold, and its vulnerability to outside shocks like trade, climate change, and other regional and global changes. In recent years, the nation has had to contend with issues like poverty, political unrest, and security worries. They have also advanced in fields like healthcare and education despite obstacles. The administration has also put measures into place to promote investment and economic development in the nation. Burkina Faso's benchmark interest rate was last recorded at 5%. 9. Benin. Benin, like its neighbor Burkina Faso, is a member of the Economic and Monetary Community of West Africa, whose Monetary Policy Committee is chaired by the Central Bank of West African States. The lack of investment prospects and the country's struggling economy are the causes of Benin's low credit rating. The interest rate of the nation has also been impacted by outside variables, including international monetary policies and general economic conditions. Despite having a sizable agricultural sector and cotton as its main export crop, Benin still struggles with issues like poverty, unemployment, and a sizable informal economy. Improving access to credit and financial services is one way to potentially help reduce interest rates for the poor in Benin. This could involve initiatives to increase competition in the financial sector, which can help drive down interest rates by giving borrowers more options to choose from. Benin's current interest rate is 5%. 8. Mauritius. The Bank of Mauritius makes all decisions concerning interest rates in the country. Factors influencing the low interest rate in Mauritius include inflation, economic growth, monetary policy decisions of the central bank, and global economic decisions. Additional external factors are changes in global interest rates and international trade policy. The Central Bank of Mauritius unanimously decided to raise its key repo rate by 50 basis points to 4.5% in December of 2022. This marked the fifth rate hike so far that year, bringing borrowing costs to the highest since October of 2015. This was with the aim to close yield differentials with other countries, contain FX volatility, and inflation pressures. In order to increase the rates, the government can still increase its borrowing, which will increase the demands for loans, improve its economic growth. While the central bank could tighten monetary policies by reducing the money supply and increase the reserve requirement for banks. 7. Comoros. The discount rate is the benchmark interest rate in Comoros. The Euro Overnight Indexed Average Rate is used to calculate this discount rate. In 2021, GDP growth increased to 1.9% from 0.2% in 2020 as their economic activity picked up. Agriculture, which rose by 3.7% and benefited from favorable weather conditions, backed it on the supply side. Exports increased by 19.5% in 2021, following a decline of 52.4% in 2020, which was primarily driven by external demand on the demand side. The central bank maintained the reserve requirement rate in order to assist its expanding economy, while raising the interest rate to 3.1%. After the economic slowdowns following the COVID-19 pandemic, Comoros' slow recovery can be attributed in part due to the lower performing services sector, lower tourism, and sanctions on fertilizer for the agricultural sector, among others. 6. Libya. The Monetary Policy Committee of the Central Bank of Libya makes interest rate decisions in Libya. Hence their decision to harmonize interest rate, which helped in the regrowth of their economy. The economic recovery of Libya is gaining pace thanks to a significant increase in oil production in 2021. Investment and household consumption fueled growth on the demand side, after the nation suffered an economic hit by a number of shocks, including political unrest, a drop in oil prices, and the rapid spread of COVID-19. In addition to the low base effect, political stability advancements, and the reopening of significant oil fields were all represented in the recovery of 2021. Libya's interest rate is currently set at 3%. 5. Algeria. The discount rate is the interest rate levied by the Bank of Algeria on loans made to banks and finance corporations through a competitive bidding process. The Algerian economy began to recover in 2021 with a growth of 4%, following loss of 4.9% in the previous year after the negative shock of the pandemic and the drop in oil prices. The increase in demand for oil in particular, as well as its expanded production and higher prices, helped to support growth in the country. These changes, along with the consolidation measures in 2021, resulted in a 4.8% decrease in the budget deficit. This led to a decrease in food supplies and inflation surged to 7%. All this resulted in the reduction of the interest rate from 3.5% to 3% by the central bank. Let us take a break here. We hope you are learning a lot from this video. If so, like and subscribe to the New Tourist channel, and do not forget to turn on notifications to get notified whenever we upload videos like this. Let's continue. 4. Morocco. The Central Bank of Morocco, Bank Al-Maghrib, makes all interest rate decisions in the country. In an effort to control inflation, Morocco's central bank increased its benchmark interest rate by 50 basis points to 3%. Morocco has attracted foreign investment and seen an improvement in its fiscal position in recent years, which has helped support economic stability and potentially contributed to low interest rates. It was anticipated that inflation could rise to 6.6% in 2022 before dropping to 3.9% in 2023. However, it is anticipated to increase once more to 4.2% in 2024, as Morocco plans a reform of its subsidies. This year, inflation should decrease as rates increase and commodity prices stabilize. 3. Botswana. The Bank of Botswana makes interest rate decisions in this country, with the bank rate serving as the official interest rate. During its meeting in December 2022, the Central Bank of Botswana maintained the 2.7% benchmark interest rate. The choice was made with the intention of maintaining support for the current economic recovery in the face of significant inflationary pressures and uncertainties. Botswana's annual inflation rate decreased for a second month in October 2022 from 13.8% in September to 13.1%, although it is still much higher than the ideal 3% to 6% range set by the central bank. The bank anticipates that by the third quarter of 2024, inflation will be on a declining trend and within the target range. In terms of growth, the domestic economy will function below capacity in the short to medium term, preventing any pressures for inflation brought on by demand. 2. Seychelles. The monetary policy rate, set by the Central Bank of Seychelles, governs interest rates. Seychelles is still heavily reliant on tourism, making it highly vulnerable to changes in the socioeconomic environment worldwide. Investor interest in the area of the offshore economy is rising, and the second largest industry is still fishing. 2/3 of the labor force are employed by the public sector, which is made up of the government and state-owned businesses, and generates the majority of the economy's gross domestic product. The Central Bank of Seychelles could raise the reserve requirements for banks, increase the benchmark interest rate, or implement other policies to encourage borrowing, which would increase demand for loans and potentially push up interest rates. Seychelles' interest rate is at 2%. Last on this list is Cape Verde. Cape Verde has the lowest interest rates in Africa. Its benchmark interest rate is at 0.3%. The Monetary Committee of the Bank of Cape Verde makes interest rate decisions, and the reference rate is the official rate. Cape Verde is a small island nation with a relatively small economy, which limits the demand for loans, thus keeping interest rates low. The country has a relatively stable economy with low inflation rates. Their economy is largely dependent on tourism that can lead to fluctuation in demands for loan, hence a reason for their low interest rates. In order to increase rates, their government can invest in diversifying their economy, which will increase demands for loans. The Central Bank of Cape Verde could implement monetary policy measures, such as increasing reserve requirements or adjusting interest rates, to influence the rate in the country. Over the past 10 years, a significant increase has been seen in the body of observational research examining the detrimental effects of low interest rate environments. These studies demonstrate how the prolonged period of historically low interest rates following the financial crisis contributed to the buildup of financial vulnerabilities and imbalances, increasing systemic risk. Maintaining low interest rates for an extended period of time can lead to economic over-indebtedness, overvalued asset prices, misallocation of resources, and lower overall productivity. In such a case, the central bank's decision-making may be hampered because tightening monetary conditions, however desirable, may result in an increase in debt service for households and non-financial corporations, thereby increasing non-performing loans and risk premiums. It is important to note that interest rates are subject to change over time, based on various economic and political factors. We have come to the end of this video. What do you think can be done to increase the interest rates in these countries? Feel free to share with us in the comments section. Also, like and subscribe to the New Tourist channel, and do not forget to turn on notifications so you get notified whenever we upload videos like this. Thanks for watching, and see you in our next video.